How many delegates have joined now? Vikas, any idea?
In terms of delegates on the Hive, we cannot see how many delegates actually have joined. But as I was mentioning that 700 people have participated, registered for participation. So we should have a good number in terms of people joined already. Hello. So, Chairman, we are on live now, and with your permission, can we start?
Yes, please.
Good morning. My name is Vikas Mohan. On behalf of CII, I welcome you all to the CII CFO Conclave. In 2007, finance professor and former Wall Street trader Nassim Nicholas Taleb wrote a book about what he termed as black swan events. Taleb argued that black swan events are impossible to predict due to their extreme rarity, yet they have catastrophic consequences. As a result, it was critical for companies to always assume that a black swan event was possible and to plan accordingly. COVID-19 a black swan event and implicating governments and businesses alike with unprecedented disruption and risks. It is a crisis that has profound implications for companies globally. From complete or partial shutdown of factories to supply chain disruptions to labor migration and shortages to cash flow stress, corporates are feeling the business and financial shock of the COVID-19 outbreak. Several economies, including India, have all braced themselves for a short-term economic slowdown. As companies navigate the ongoing COVID-19 crisis, there are several key issues corporate leaders and CFOs should be thinking about, as well as steps they are taking to reshape their business and plan for recovery. With the management and the board's focus is on addressing the impacts of the COVID-19 crisis on the company's operations, it is imperative that CFOs enhance their efforts to provide strategic insight and oversee short and long-term horizons while continuing to exercise the fiduciary responsibilities. CFOs play a crucial oversight role with such challenges given their collective experience and overall business judgment. CFOs can significantly assist the board and audit committees not only with how they respond to the crisis, but also how they plan to recover from it with resilience. Combined with concerns about the economy, the times ahead would require a careful balance of near-term focus, agility, and long-term thinking by the CFO. It is with this context and to address issues revolving around unpredictability and the challenging environment, and with an attempt to probably crystal gaze the future, we have collated four very interesting panels with top 30 CFOs and senior experts over a 2 day span who all will be sharing their enriched insights and experiences as to how they have dealt with the pandemic and what are likely to be their business continuity plans and future strategies to sail through and survive out of these challenging times. The first panel discussion session today is with the theme Economy, where do we go from here? I take pleasure in welcoming and introducing an extremely enriched and diversified panel with you. We have with us Mr. Ramesh Subramaniam, Chairman, CII National Committee for CFOs and CFO, the Tata Power Company. Mr. Subramaniam will also be moderating today's panel. Mr. Madan Sabnavis, Chief Economist, Air Ratings. Mr. Swagata Bhattacharya, Chief Economist, Axis Bank. Mr. Giridhar Sanjeevi, Executive Vice President and CFO, Indian Hotels. Mr. Daniel Spindler, Executive Director and CFO, Siemens. Mr. Pradeep Gode, Founding Member and Managing Director, C2FO India. And Mr. Siddhartha Nigam, Partner, Grant Thornton, Bharat. Thank you all for your time and for kindly agreeing to join today's panel. I am sure we will have interesting insights from the combined of learned CFOs, economists, CEO, and an expert who advise clients on a daily basis. Before handing over to Mr. Subramaniam, I would also like to thank our partners to the conclave, I would like to sincerely thank our technical partner, Grant Thornton Bharat, co-partner AZBN Partners and associate partners C2FO India, Kroll, a division of Duff and Phelps, Primus, an insolvency resolution and valuation services firm, Tata Consultancy Services, and of course Tata Power Company. One more announcement, and this is for the participants. We plan to spend last 15 minutes for the Q&A. If you have any question, please jot down your question in Ask a Question box on Hive platform and address to specific panel member. Panel members will then pick it up and answer your question as feasible and as time permitting. With these remarks, I once again welcome you all to the CII CFO Conclave. And may I now invite Mr. Ramesh Subramaniam, Chairman CII National Committee for CFOs and CFO, the Tata Power Company, for his opening remarks and to moderate the session, please. Thank you.
Thank you, Vikas, and very good morning to all of you. It's a great pleasure to be at the annual conclave for 2020, and I'm glad to say that one of the advantages has come out of the pandemic is that webinars have become quite easy and people have found it easy to attend, and also in our availability time, it's really improved. So thank you for being here. It gives me great pleasure to welcome Madan Sabnavis, Shogoto Bhattacharya, Daniel Spindler, Giri Giridhar, Siddharth Gode, and Pradeep Nigam. Thank you, gentlemen, for making time. And I think it's a very good panel, I would say. We've got two economists, one of whom also is also a banker. And then we've got two CFOs from very different industries, and somebody from the Siddharth from the a very different world altogether, CFOs. And Pradeep, who kind of has a good overview of the industry, being one of the partners in one of the largest audit and consulting firms. So it's a great. I hope to instigate some thoughts and also get insights from all of us, and hopefully we take out some meaningful conclusions from this session. Thank you. This session is in a way quite well timed, because last 6 months has been quite a bit of doom and gloom. One was really dying to see where is the light at the end of the tunnel. And while one may say that it's too early to say that there is some semblance of economic recovery, but are somehow moving in the last month or so. While US is continues to get seriously challenged, hopefully with elections, things will somehow get back to normalcy. But there is a second wave of the pandemic in Europe, and the rest of the world is struggling to recover. China, of course, seems to be the only economy, at least as they claim, to be out of the problem caused by COVID. I will tone for the session from the latest interview that the Minister gave recently to a business newspaper, where he said that there are 5 clear indicators, according to him, of revival. There's been record production in agriculture. There's been FDI growth up 13% from last year. Auto and tractor sales looking good. Steady recovery in manufacturing. And more importantly, and it surprised me a bit, I didn't know this, that the Provident Fund, EPFO subscribers is up 34% new subscribers in August. Our economists on this panel would probably decode it for us, whether these 5 indicators, as the PM claims, are clear indicators of a revival, are really indicators of a revival in their view. But for the moment, if the data is there, data is right, and are we really seeing improvement? The CII's business confidence index is also to a level of 50.3 in July-September, which was a low of 41 in the last quarter, which clearly means that there's been a clear uptick in what the business fraternity thinks about the economic outlook. The looking at the outlook also released by OE, which says that world economy is to contract by slightly milder 4.5% in 20 as against the 6% earlier, and they expect the bouncing back in 2021. So with that kind of drop, I think it'll be interesting to see whether we could collectively figure out for our or as to look positive momentum from here, or is it too early? And if so, what to look out for? So I would start with Madan Fadnavis, Chief Economist at Ratings. And Madan, you are looking at the entire industry at large. And my question to you, that are you seeing signs of recovery? Are you, what kind of key indicators make you believe there is a sign? And so what kind of GDP growth are we seeing in this year, following 2 years? Because there is a clear view that next 6 months, things will not improve. So request you to give your on this, and then we could take out from there.
Thanks, Ramesh, and very good morning to everyone. Like an economist, I'm not going to give you a direct answer. So we economists tend to go round and round, and then we'll leave it to you to figure out what we're trying to say. Now, on a more serious note, I think when we talk about a black swan event, which Vikas spoke of, I think it's true that this is a black swan event. None of us really knew what was going to happen. And in fact, we at Care Ratings, when we made a projection of GDP growth, just when the announcement of the lockdown came in, we had actually looked at a mildly positive number of 1 to 2%. And we were quite happy when we got to know that IMF had a slightly higher number, that we were not really off target. But then the way the lockdown proceeded, one was not quite sure as to how long it would last. I don't think the government was also sure, so the number of extensions which kept coming on. And as these extensions came on, I think we became more pessimistic, because when economic activity is not permitted, it's but natural for us to expect that the GDP growth would be slowing down. So we had changed our forecast in the month of around May or June to something like negative 1 to 2%. And as the unlock process began, we were more confident about things happening in the economy. So therefore, we had an estimate in the region of around minus 6.5%. And by the end of September, we thought, let's now take a call, because we are definitely moving in the direction of unlock. We know what's happening in various sectors, which sectors are opening up, which are not opening up, where there are localized lockdowns, how labor has reacted, where the investment is taking place. And we were able to come to a number of around minus 8.2%. Okay, and when we did look at what were the growth rates or the degrowth rates which were provided by different economists, it had ranged from minus 6.5 to minus 15%. Okay, so all of us know for one thing for certain that there's going to be negative growth in GDP in the current financial year. Now, in between, we had the Q1 numbers which came out, where it was said that the GDP had actually fallen by minus 24%. Now, here comes the thing when I was saying that I'm not going to give you a straight answer, because the thing is that when GDP fell by 24% in the first quarter, and almost all estimates of GDP growth, or rather degrowth, are in the region of, say, 6 to 15%. Let's take a midpoint of what we are talking of 8%. Maybe RBI spoke of 9.5%. So I think one of the major premises was that there would be an economic recovery. So if you tell me, how did I come with an 8% growth rate or degrowth rate? It was that I looked at Q1 of minus 24. I had a number for Q2, Q3, and Q4. And therefore, there was a certain plan which we had in mind, which we thought would get executed within the economy. But I think one particular peculiar feature of this particular crisis is that it's a man-made crisis. It's not that my financial system crumbled and therefore there were repercussions for the rest of the economy. It was simply that we said at one point of time that the economy cannot operate, people cannot produce, people cannot consume. Then we gradually said that you can produce certain things, you can consume certain things, you cannot do other things. And even as we stand here in October, in the month of October, or at the end of October, there are certain services which are partly opened up, fully opened up, and so on and so forth. So while manufacturing seems to be having more liberty in terms of functioning, we don't have the same thing in a number of services for obvious reasons. And therefore, when we say that degrowth was supposed to be 8%, 9%, or 10%, even if you look at the RBI, which is the official statistic which we have, it is to say that there's a recovery expected in this particular quarter. So today, we should not get ecstatic by saying that, look, Amazon and Flipkart have recorded so many thousand crores of sales. That was all supposed to be a part of the plan, because people do have this concept of pent-up demand and things which are going to come up. Therefore, if auto sales are going up, it's not really shocking. In fact, I would say that we are quite encouraged that things are going according to plan, that there is a bit of pickup in consumerism. And hopefully, if in case this is sustained, which is what we are expecting also, that Q3 growth will be closer towards zero. Q2, we're still looking at a double digit around 9.5%, 10%. Q3 maybe around -5%, -6%. And we're actually talking of a marginally positive growth rate in the fourth quarter. That's how we at Care Ratings have come up to this number of -8.2%. I'm sure everybody who's drawn their forecast is actually assuming that there's going to be a major ramp up in activity when it comes to the third quarter. Now, actually, the question of whether we are on the right track, yes, obviously we're on the right track. The growth is going to take place. If you're going to ask me as to what's going to happen in the next financial year, again, I think economists, analysts, everybody would like to have a big number, saying 8.5%, 9%, 10% growth in GDP. According to me, I would tell people, please don't look at that number at all. Because if I'm going to have a negative growth rate in this year, so for example, I'm just making numbers easy, they're approximations. GDP in real terms was, say, 145 lakh crores in 1920. I'm talking of us going down by, say, 10% this year. So I'm losing around 15% of GDP, 15 lakh crores of GDP. I'm coming down to 130, 132 lakh crores of GDP for this year. Next year, if I get even a 9% growth, I'm going back towards the 145 number mark. So therefore, I think this entire thing of saying that it's a great thing happening, that India will be the fastest growing economy next year, let's temper that. Yes, numerically, statistically, we're going to be very much better off. But we could just about be coming back to the level of 2019-20. I think the crux of the problem, I think the point which you raised about one of the parameters which has been raised is employment. According to me, growth really takes place if jobs are being created. If people like you and I and all of us in this panel discussion, all the delegates out here, we are happy that our salaries are going up, our companies are hiring more people, then I would say that there is definitely we're moving in a positive direction. I don't give too much of importance to the EPFO numbers because we really don't know how that is calculated, how those numbers come up. CMIE has their own numbers. Again, that is based on a survey. So we need to have indicators, so these are very good indicators. But honestly, I think we in the corporate sector, if we just look into our own company and say, are we hiring, are we firing, are we restoring the salary cuts, do people really have that kind of spending power? Then I would say that we have reached a stage where we can be confident that the Indian economy is actually growing at 7 to 8% in the real sense. So next year's 9.5%, 10%, whatever number comes through, should be accompanied by strong growth in employment. If that doesn't happen, then I don't think there's much to rejoice. And therefore, we feel that real economic growth, I mean, in the olden days when we had that 7 to 8% growth, is something which we can witness not in 21-22, but probably in 22-23. That's when we can come down to this level of around 7 to 8% growth in real GDP, which will go along with the job creation.
Right.
Now, I think one good part is that we have seen very affirmative action taken by the Reserve Bank. So they have done everything that that from the monetary side could be done. Lots of liquidity, lower interest rates, LTROs, TLTROs, all these kind of things to make sure liquidity is there. A moratorium given there. I think Saugata will have more to talk about it. But we feel that this moratorium, removal of moratorium, one-time restructuring is going to camouflage a lot the real state of a banking sector. So we feel that NPA level will probably be 15% by the end of March. It can be camouflaged with all these restructuring because all the concepts keep changing. But the true picture is it could be quite a ghastly number in the region of around 15%. Government has been proactive, but I think the government's ideology has also been revealed that the government is going to be an instrument. It's not going to be an instrument of growth, but it's going to be more a facilitator of growth. So therefore, they have created an enabling policy environment, a brilliant environment in the Atmanirbhar 5 tranches. But in terms of spending money, it has been restricted more to helping out the needy. So therefore, money spent for the poor, in the Riga allotments, that is something which is positive. So let us not really expect that there's going to be a third round of fiscal stimulus, big bang expenditure and Capex. That's not going to happen this year. Probably next year, we have to see what the budgetary numbers look like. But as of now, let's temper our expectations out there. The government has done a good job. The RBI has done a good job. The private sector needs to take the initiative. They will take it only when they see consumption. Consumption is going to pick up only in case there are more jobs created, there's more spending power. So I think that particular cycle will probably take a little time to materialize. Okay, so I would end here. These would be my initial comments.
I think
Thank you.
Excellent. I think Madan, what thing is that some statistics read out by the government not necessarily are indicators to be sure they are doing the right things in terms of setting the right environment. This is they don't. The government doesn't want to get in directly into an intervention mode, but they want a facilitating mode. And I think also you mentioned a point that in terms of monetary policy, I think we have done good. I think that's a great start to start checking with Sato as to whether we, in terms of the debate about how intervention and how much is monetary intervention that is needed. And there's been also a lot of debate that needs to be done, only limited stuff on the monetary side. So, and impact of the pandemic, a lot of NPA expense that is spent, and some of them also done a lot of capital raising in the meanwhile to protect their balance sheets. What's your view on what RBI is doing and doing well, and what it should do a little more, and from Madan, that we must ask ourselves whether we are spending more as corporates, we are hiring more, are we looking optimistic on our cash plans? What's your view from a growth perspective? And also, what do you expect the government's move in the next few months? There has been talk about another round of stimulus that's coming our way.
Subramaniam, thank you so much. Thank you and CII for giving me this opportunity of interacting with all of you. So first, let me start with the economy. I agree with Madan that we are also looking at about an 8% contraction in FY21. But the actual situation, the reality on the ground is probably worse. Because the data that we are getting basically captures the formal sector. It's not very representative of the informal sector, and the informal sector has been the one that has primarily been hit. Secondly, recovery is likely to be quite prolonged because one of the reasons is that all balance sheets of corporates, balance sheets of households, banks, and certainly the government, the amount of debt that the government has increased, both center and the states, will definitely prolong the recovery. Recovery will be modest, probably, and a prolonged recovery. The effect on banks needs to be looked at much more carefully. The entire financial sector, not just banks. RBI models in July had suggested that if growth contraction, in that extreme case that they had considered, in 9% growth contraction, and we are already probably there, I mean, probably even more, then we would see an NPA level of around 15%. So we need to take that into account. As you mentioned, banks also have factored this in. I mean, especially private sector banks have raised lots and lots of capital. Shock absorption, loss absorption buffers, higher provisioning. You would have seen the results. I mean, provisioning has come down, but certainly in Q1, very high provisioning ratios. As a precaution, banks have strengthened their risk guardrails. Guardrails have been tightened. So obviously, I mean, all of these things has led to what is now extensively called a degree of risk aversion in lending. So remember that banks have a very large fiduciary responsibility for depositors' savings. So we need to be very, very careful on this. But credit appetite still exists. I mean, there is no doubt about that. One of the key things that the Reserve Bank and in consultation with the government had done was the ECLGS scheme, that remember the guarantee scheme for MSMEs. And banks have disbursed a significant amount of credit, 1.5 lakh crores at the last. So, I mean, and that has helped. That has really helped the SME sector in the initial survival phase of the economy. And I'm quite sure that credit growth is likely to pick up in H1. We have already seen that in the last week of September, credit growth has picked up. As Madan also mentioned, RBI has been very, very proactive, very innovative in the use of instruments in dealing with this crisis, deployed a wide range of instruments, measures, and has stabilized the situation. The government also, to their credit, within the scarce resources, has managed to do maximum that it could have, given the constraints. So my own belief now is that a stimulus measure is required. A further stimulus is required as of this point in time. Obviously, there are trade-offs because one particular one is the risk of a credit rating, sovereign credit rating downgrade. So that exists. But in extensive discussions with the global credit agencies, the sense that we get is that the most important concern is growth. The set of developed market credit rating downgrades that we have seen are essentially based on the growth prospects. Everybody knows that this is an extraordinary situation. Normally, all levels of government debt, etc., are looked at in a typical economic cycle. This is not an economic cycle. This kind of shock, the black swan that Vikas Saab mentioned, etc. So my sense is that to prevent a further erosion of growth drivers, I think a significant amount of government intervention is probably required, supported by the Reserve Bank of India from their balance sheet. How the government spends has become a very, very critical component, which I'll probably look at a little bit later. Thank you.
In terms the monetary, and I think the I agree with you that the MSME supports has really been welcomed. So much pain was being realized in the early stages of the pandemic, which of course has come down seemingly. And you're saying that the further is absolutely a must, because we cannot be taking shelter under inflationary fears or fears of sovereign downgrade. I think it's more important thing to worry about is growth. Is what I'm hearing from you. Great. I think that also would set the stage for saying that if the level at the policy level there is support, and at the RBI level there is a great willingness and actual experience we are having of kind of supporting the industry. I think clear checkpoint that is this working. And I have Giri Sanjeevi, who CFO and VP in Indian Hotels. And I think my question to Giri would be, when you see the space of tourism and hospitality, and are you sensing the support system coming your way visibly, and what is the kind of looking at for the pace of recovery? What accelerating measures that are clearly expected and not happening? And also, are you also suddenly realizing that the way of doing this business itself would need a change given these circumstances?
Can you hear me? Can you hear me? Can you hear me, Ramesh?
Yes, please go ahead.
Yes. Thank you, Ramesh. No, I think it was very interesting to hear what Madan and Saugata were saying. I think one of the things about the tourism industry, I work, as I know, for hotels, as you all know. And I think one of the things about the tourism industry which people don't completely recognize is that it's one of the biggest contributors to GDP globally. It is a massive employment generator. It is a massive tax generator, both in terms of direct and indirect taxes. And third is that for countries like India, it's also a massive foreign exchange generator. And I think the industry has been coming along well as far as India is concerned. And pre-pandemic, I think we were definitely seeing growth in the industry. The pandemic, of course, has been a rude shock in terms of the impact, because we are one of the frontline industry which has clearly been impacted. And hence, I think after the initial bit of confusion in terms of how we should react, I think our response has been largely fairly systematic. I think number one, very clearly we have hunkered down in terms of spends, very carefully looking at and taking very decisive actions on spends. Having said that, in line with the values of the Tata Group, I think the spend optimization efforts has been human in approach, which means that it is not been indiscriminate in terms of impacting employments and livelihoods. So we've been trying to do it in a very balanced fashion. So that's number one. Number two, obviously, balance sheet is a big challenge. And currently with revenues, when revenues come down to near zero and expenditures take time, it's a high fixed cost business. So you're really living on borrowed monies. And I think, and therefore, I think we have been able to ramp up borrowings to support the business. And one of the things we have tried to do very honestly is to make sure that there are nothing short term actually. It's all been 3, 6, 9-year monies. And therefore, from a balance sheet protection perspective, I think we're kind of building a fairly good balance sheet to support our operations actually. And this is where I would also say that as the Madan and Saugata said, the RBI efforts in terms of liquidity, the LTRO operations have all come in very handy in terms of generating the much needed liquidity for us actually. So that is number one actually. Number two is that it's interesting to see, I mean, I think where we sit today is that we're definitely seeing green shoots of recovery. The leisure travel has clearly picked up. Weddings are picking up. Business travel is, of course, slow. And we don't know how the business will pick up, but I think one good thing about the hospitality industry in India is that October to March is the peak season traditionally. And in a way, we are lucky that the pandemic hit us in the month of March. Therefore, the bulk of the impacts, whether it is lockdown, whether in terms of what do we do, has all come in the first half of the year, when traditionally it's only 30% of the business which kind of comes in. So to that extent, while it's the black swan, it's fortunate that it has come in the lean months of the year actually. Now, so this is as far as what we are doing. Now, if I look at, because we are a global company with operations in UK and the US as well, it's been very interesting to see how the governments have reacted internationally and what are the learnings for India actually. I think if I look at UK and US, and UK in particular actually, the government has really moved very fast in terms of protecting livelihoods actually. If I look at our own industry, what we very clearly saw is that they came up with an 80% kind of a subvention scheme where 80% of the pay of employees were paid to the government who had a salary threshold of up to 2,500 pounds, which means, and the reason the government did it was to say that it was encouraging companies to sort of protect employment. So therefore, as far as we are concerned, if there is an X amount which is payable in $1 million, let us say, is payable in terms of payroll, and 80% of it is picked up by the government, we have paid the 20% actually. And therefore, I think what has happened is that our wage bill has come down. We have been able to protect employment actually. Similarly, the UK government has been very good in property tax waivers actually, because property is inherent in our industry, and therefore property costs are very important actually. And the third thing, very innovative from the UK government, is that beyond support, they started a scheme called Eat Out to Help Out, because ultimately it is consumption has to come back. People have to start spending. And they came up with a brilliant scheme which said, you know what, go and eat in restaurants. And up to a certain wage bill, excluding alcoholic beverages, we will subsidize 50% of that wage bill, which means that if your bill was 20 pounds, 10 pounds you didn't have to pay, and the restaurants would claim on the government. So it's a fantastic scheme where beyond salary subsidization, the government was encouraging people to go out and eat and therefore help in the revival of the industry actually, because consumption has happened. Similarly, in the US, I think the entire payroll protection program has been useful in terms of helping. I think when I look at that, and that has helped us enormously in terms of not just protecting employment, but also able to sort of protect our P&Ls and balance sheets and cash flow support. If I look at India, I must say that the support in India, RBI, of course, as I said, has been fantastic in terms of some of the liquidity measures which have come in. But from a fiscal support perspective, I think very clearly the government has struggled to do it. The relief and the stimulus measures that the government has announced has been more at an individual relief perspective rather than industry-specific reviews, actually. And I think this is an area where I think from an industry perspective, I will certainly say, and in general, I would say that the government perhaps needs to be bolder because the reality is that these are unusual times. And if I look at some of the macros, like what Saugata said, you know, in terms of India's debt to GDP, I think it's okay. It's about maybe 75% of GDP. I think if the government is worried about inflation, the reality is that monsoons have been good. I don't think there's a very big inflation risk actually. And FRBM caps also, if you look at it, I think we have a flexibility up to 3.5%. And even if you have to breach that in terms of FRBM caps, I think the government definitely can be much bolder in terms of bringing in the fiscal stimulus and helping industries actually, because it's very, very important in a black swan event situation like this. I don't think there is a need to sort of hold back. It is okay to spend, even if some of the measures go kind of out of kilter in the short term, it can always come back actually. And hence, I think what we would really like, not just for the tourism and hospitality industry, but in terms of response to the pandemic, a better program, a more aggressive fiscal program, a bolder program, which allows the recovery of industry, protection of employment, resumption of consumption-led growth. All of these have to come back actually. The other thing I would say is that one of the very important things as companies seek to pivot in this pandemic is also to look at some of the long-term trends, because very clearly what has happened is that the demand, structural changes in demand are taking place. That's number one. Number two, structural changes in supply are also taking place because balance sheets are getting impacted. And I think what we have tried to do in terms of our response to the pandemic has been trying to look at long-term implications of the pandemic in terms of structural changes. So, for instance, as a 115-year-old company, in the last 6 months, we have launched an app-based business in food and beverage. And suddenly we think it can be a very big business. Digitization, app-based businesses, re-looking at operating models, all of these are long-term trends. And one of the things going a little beyond the hospitality industry, and if I look at wider, because of my own personal interest in, say, the private equity ecosystem actually, and the angel investment ecosystem, I do see that the startups, I think, offer some fantastic reason for hope actually, because they are going into areas and experimenting, and capital is being supporting some of those initiatives. Where, and if you look at what the government itself is doing, the whole financial services stack, which Nandan Telangani has pioneered with UPI, and all of that has been fantastic. The second one is government is not talking of a health stack, and it is very well supported by the startup ecosystem. I think there is much to learn in terms of startup ecosystem and driving some of the structural changes, also providing employment, because the reality is that corporate can never provide the full employment. It has to, India ultimately is a nation where entrepreneurship has to provide the employment actually. So I think there's much to learn from a startup ecosystem actually, especially for large corporations like us who are seeking to pivot and come out on the other side as a much better, and much better prepared corporation actually. So I will stop here and I will pass it back to the panel for their comments next time. Thank you.
No, thank you, Giri. I think what you're saying is that there are great examples right now how some of the governments have handled the pandemic in terms of job protection, employment generation, and also promoting the demand growth. And you mentioned the example of the property tax, the interest subvention, so the subsidization when you typically in restaurants in the UK. I think there are good examples which you gave, and also I think I totally agree with you. I think we must look at this industries which are manpower intensive. They require double focus, because it is not just a demand creation issue, but also a huge problem that we are sitting on if we don't provide that stimulus. I think during the discussion, I think we'll come back to the point, and for both our economics, Madan and Shobha, are they really seeing this part of the coming stimulus program, which the government is working on? Now, while the industry and the tourism industry is a critical component, the other is really infrastructure, which is clearly something which the government, I think, is already clear that that's an area of really quickening the pace of recovery would be depending on. So Daniel Spindler from Siemens, I think it'll be very good to understand a couple of things from you. Do you see a change in the demand for infrastructure related items, which is Siemens specializes in? You also do some consumer products, I know. But more importantly, what has been your experience globally? Siemens operating in so many countries, especially including China, Europe, and US. What do you see clearly as a learning that could be just transplanted to an Indian situation quite easily, and based on what results have been from the governments elsewhere? So what's your view on this? Can you just share with us?
Yeah, so thanks, Ramesh, and very good morning to everyone. Hope you're all healthy and safe. So let me start like this, Ramesh. India is one of the world's hotspots for the COVID-19 pandemic, as infection cases were rising over the recent months to almost 100,000 new cases per day. Thankfully, now we are experiencing a declining trend already for some weeks, which also hopefully continues and prevents us from having further strict lockdowns, like we are seeing them, for instance, now in other parts of the world, like for instance in Europe, but also USA. In India, the nationwide lockdown imposed across India was the longest, probably the biggest and the most stringent in the world. Economic activity, including Capex and investments into infrastructure, as we were alluding to, came to an abrupt halt in the country, and that had also devastating impacts on an already, in my opinion, slowing economy, because we were experiencing it, our order book was already showing signs of slowdown even before the pandemic hit us. So as we know and already heard from Madan and Sugata, the Indian economy contracted by more than 20%. More than 20% in the April to June quarter, and most likely another 8 to 15% in the July to September quarter. And that's probably the worst decline for 25 years, and it's also worse than any other world's biggest economist, because we were saying, how is the rest of the world doing? So I'm seeing that this slowdown in growth was probably the biggest impact here in India. And we can really see this negative impact also when we are looking at other countries within our Siemens group. So for the Indian economy, we were talking about the private consumption investments. And in my opinion, private consumption and investments, the infrastructure, of course, are the two biggest engines for growth. So during the first quarter 2020, private consumption fell by close to 30%, while investments like in Capex from the private sector even fell by almost 50%. During the last 2 quarters, we saw some increases in government spending, but I totally agree to the other panelists that we would expect here more stimulus from the government side to be then more bold, because we believe it was not adequate to compensate for the decline we all suffered. Especially labor-intensive sectors such as construction, real estate, retail trade, and for Siemens, most important, transport, manufacturing, and also energy was contracting quite sharply when it comes to the capital good expenditures. So as per our observation, Capex will remain to some extent subdued, not only during the last quarters, but also, of course, for the next quarters to come. Of course, the reason is the ongoing pandemic. However, we also see some promising signs of recovery, which, for instance, also the manufacturing PMI shows, which is trending now above 50. I think it's 56.8 last one I have seen. So that is quite promising, and I personally also believe that the economy will see some recovery. Because moreover, few indicators, let's say power consumptions or passenger vehicle sales, e-way bills, also showing some signs of revival after the government eased the lockdowns. But a sharp V-shaped recovery, in my opinion, is unlikely to occur during this fiscal year. And I think I'm also in line with what the other panelists were already saying. So in my opinion, the economic recovery will be modest and uneven, with some adverse consequences on output, employment, and financial stability. And both private consumption as well as Capex will take some time to recover and reach levels prior to COVID-19. And until domestic demand is not fully recovering, business will also not undertake fresh investments at large scale, which in turn would help, of course, to boost employment and the overall economic uptick. On the positive side, we see huge opportunities both on the digital and technology front, which are emerging right now, even in an environment of poor demand visibility and low capacity utilization. And I think that would be an advice to the industry here. In order to stay competitive in these new businesses and economic environment, it will require also new strategies and practices. Technology is of strategic importance as a critical component of the business, not just because of cost efficiencies. And an area, in my opinion, where companies have already adjusted well is using technology to address changing work environments, the new normal, the working from home, in order to stay competitive. Organizations that are successfully responding to the crisis have accelerated their digitalization, and I believe we are one of them, because it's very important to us. It's a strategic pillar more than ever before. And supply changes and internal operations and product lifecycle management also has to be relooked at. So I would like to draw your attention to two important areas which offer significant potential for the industry here. So firstly, I mentioned already, digitalization will undoubtedly play a center stage role. And the other significant area that we are seeing are new business models. So technology initiatives based on Capex models, which usually yield positive returns on investment and payback periods as short as 2 to 3 years. On the other hand, for those being averse to Capex, and I think that is now the important point, new business models are emerging. And that, for instance, may not require much of an upfront investment into licenses or software, no Capex, no extra people in the factories, just, for instance, a sharing of benefits once the performance guarantees have been met. So constant innovation will be key also for our capital goods industry. That would be my summary of my initial statements, Ramesh.
Business require less cash and probably service oriented models using Capex, but probably different balance sheets. And these are things which you are seeing. And I'll come back to you on asking your, also I think you didn't address one issue which I asked, whether globally the response to pandemic do you have any experiences which are very different from the reaction by the Indian government compared to many other countries? Is there any stark learning from that?
As you may know, Ramesh, there's a big discussion right now ongoing in Europe across many states. And I can also, for instance, talk about Germany here, our home country, that is our headquarters of Siemens. There's now the discussion to impose a new lockdown, starting most likely next Monday, so 2nd of November. And the discussion there is, of course, how can you prevent adverse impacts to the economy and to the industry, or also to the hotel industry? Because one of the measures will be to shut down all hotels for private overstays. And insofar, the discussion is very important also to see how can those who are suffering most, how can they be helped? And there are a lot of discussions now from the governmental side to, for instance, compensate companies, to compensate restaurants, to compensate people who will be suffering during this lockdown for the next 4 or 5 weeks before Christmas is happening, because that's the reason to do this now in November, so that the Christmas season, which is very important for all the businesses and important also for the families, of course, to meet and gather and meet their families at home. And there's a lot of discussion about how to compensate those. One thing, for instance, that was just yesterday announced is to compensate 70 to 75% of their missed revenues. And I think that would be very important, of course, to help the ones who are really suffering during this time, to provide some good compensation and to provide funds in order to keep that life. Because as I already said, in order to stimulate also domestic demand, people need to have, of course, income, reliable income and predictable income so that they can invest. And only in that, if that is happening, and I think the whole economy will also continue to be stable.
Now, when you step back on all these issues and you look back, so many industries are really reeling from the pandemic-related demand and supply side constraints. It seems that the Indian market is full of deals which are going on right now. Some major deals have been struck in the last 6 months across the M&A spectrum. A lot of activities happening on consolidation, also new entrants in the sector. And therefore, it will be very interesting to hear from Siddharth, who also heads the M&A practice. What is happening really? I mean, are people seeing opportunity here in this crisis? Or is it that there is actually a reallocation capital that is happening, and where India is looking to be a okay destination? What is the sense you get with all the frenetic activity that is happening? The more bankers I talk to, they all say that they've been very busy during this pandemic, and they've been actually very happy with the amount of work they have. So what's your take, Siddharth?
Thank you, Mr. Subramaniam. Thank you, CII, for inviting me to be part of such an esteemed panel. It's been, I was listening to the two economists on the panel, and interestingly, I'm learning a few things. I'd heard of a V, a U, or a W-shaped recovery, but the latest I've heard is a K-shaped recovery, which assumes some sectors will recover while others will languish. So that leads me into quoting Winston Churchill, who said that never let a good crisis go to waste. And I think in the middle of this, gloom and despair, there are some encouraging trends. Global M&A crossed 1 trillion in the third quarter, bringing the year-to-date total to 2.2 trillion, which is almost, encouraging is that there are about 5,500 PE-backed M&As that have happened. This is global numbers. COVID crisis actually created opportunities for PE funds to buy businesses who were flush with cash after record fundraising in 2019. So I think the context of that is quite important. Again, globally, we are seeing a very secular trend. Tech and industrial have been the biggest targets. 41% of the PE deals have happened in that space, and the other sectors, consumer and industrial, the increase is about 61% over last year. So if you see that there is hectic activity, I mean, bankers being busy is not usually a sign of great things, but I would say that here there is triangulation of those two things. Coming to India, we recorded almost 600 deals amounting to just over 36 billion in the first half of 2020. This is a 15% increase in these deal values. There has been a slight fall in volumes, but overall the value number is quite encouraging. The increase is quite encouraging compared to last year. There is an increase in both M&As and PEs. Obviously, the highlight of the year, and that is a focus on the new normal, was almost 10 billion fundraised by Reliance Jio from the best of the best investors globally. And I think this is really puts firmly the India stack on the map, that this is where future consumption is going to come from. And I would just quote Shovo Mandal, part of Tata Group, that there is still a third of India to be discovered. And I think some of these positive tailwinds on the deal activity is a sign of the potential that the world is looking at. I think in terms of numbers, again, India recorded almost 19 billion of M&A in H1 across 160 transactions. This was a 6% increase over last year. Tech sector obviously has played a vital role in this. Most of the economy working from home, which digital seems to be at center stage. Healthcare is another sector that has seen significant increase in volumes, 100 deals in H1 alone. Core sectors such as telecom, energy, banking, transport, logistics also saw transaction activity in the first half of 2020. I think I'll also bring like to highlight that despite the challenging time, the mid-market businesses are looking beyond the pandemic. We, as a firm, publish what's called the International Business Report. So the H1 2020 calendar year report shows the optimism level at 63%, putting India amongst the top 5 countries in global rankings. Our business people, our entrepreneurs seem to be optimistic and positive. Similarly, businesses also reflect positive sentiments in terms of revenue generation, with 58% expecting an increase, thereby giving an outlook towards continued market activity, which is a little contrarian to where the data points and what economists are looking at. Obviously, on the FDI front, as Mr. Chairman had quoted, that there was a 13% increase in FDI in the first 5 months, close to 36 billion. Now, this number is, when you look at it in the context of global FDI, which was down by 49% in the same period, actually looks very encouraging. Geopolitically, also India's position looks quite favorable in terms of continuing to attract investments, including relocation of global supply chains away from China. The China plus one is actually a reality, and India is well placed to take advantage of that. But we still have to learn a lot from I would say, much smaller economies such as Vietnam, who've done extremely well on getting a look in from for global supply chains. Specifically in India, I think Apple is considering moving about 20% of its production of iPhone to India, which is a $40 billion opportunity over the next 5 years. We believe the sectors where we will continue to see heightened interest are IT-enabled services, digital and internet, especially online platforms for working and collaboration, edtech, digital entertainment, content, fintech. FMCG, again, it seems secular. This is about a third of India, which needs to be catered to. Online retail, specialty chemicals, healthcare, and not just delivery of healthcare, but medical devices. I think India has taken a lead, what I would say, on the less sophisticated medical devices, oximeters, PPE kits, masks, etc., and ramped up production very quickly. I mean, fresh off the press a couple of days ago, we saw one of the largest private equity deals in an online platform that provides animal protein to the people. So again, it shows that way forward. I think finally I'll also just allude to a little bit around the problems in the credit book of banks. I think IBC is a very effective law. We as a firm are very active in working with lenders on trying to resolve problems. Obviously, this pandemic is going to expedite distress and cause stress in many healthy companies. I think we've got a great law. It has certain things which need to be looked at by the regulator, the policy makers around things like cross-border insolvency. I think we need to quickly address that. Moratorium on creditor action for those who commit to keep stressed companies as going concern. I think it's very important to keep companies alive. I think the success is in reviving and not in the death of companies. So maybe look at some positive interventions there. I think also steps to broad base the ambit of resolution applicants. One of the things that, especially for the mid-market and mid-sized companies, is not allowing promoters to bid for as resolution applicants. I think globally, pre-pack, especially in creditor-led regimes, is an important element of revival and resolution of distress. I think also getting the various government agencies and regulatory bodies on the same page, because there is still a certain amount of asymmetry when you actually get through the resolution process. And of course, is there a need to create a nodal agency to oversee timelines, preservation of value, mediation between various government agencies? I think in this whole thing, final point I'll make is that we have seen that in the lockdown, us as resolution professionals have done one of the fastest resolutions for a company called Garden Silk Mills, which was done entirely in the lockdown period, super fast, the results to see. And of course, Jet Airways is another one where we are involved and working hard in the last 18 months to get Jet to hopefully fly again. And I think in this whole environment, specifically Jet in an industry which is hard hit, we are seeing some rays of hope, and we believe that as all stakeholders, if we put our minds and efforts towards getting through the pandemic, we'll get out through that sooner. Whether it's a V, U, W, or K, I think the recovery is going to happen. That's all from my end. Mr. Subramaniam, I think you're on mute.
Sorry. Yeah. Sorry. And I think it's interesting. The recovery is a very interesting concept. There would be some down and some up. And 600 deals during pandemic, I think it's really critical because nobody realized that, we used to think that physical meetings, getting DDs done, physically, and all the lawyers sitting around with heaps of looked at an M&A deal. I think so many things are changing in this and making the economy move thanks to, I think, probably connectivity and IT and the whole technology bit that is really helping this movement. Also, you brought out the point on IBC. I agree. There is a lot to be done to make it more effective. It's a great. I just think that it needs a little bit of teeth and a little bit of cleaning of some of the edges there, which will make it very effective. And I heard you saying it's a $40 billion opportunity waiting in the manufacturing side, which is really heartening. And that goes back to what PM's statement was, that he believes that it's a big thing in the works. Peak. Now, while that's happening, the biggest learning during this whole last 6-8 months is that how many innovative businesses can come on stream and actually do real economic value add without really physical movement. And Pradeep, I would like you to talk about what you do, company C2FO, and also give us some insight that you've drawn in these 6 months. What is changing in terms of how, let's say, business is reinventing itself? And, for example, the MSME liquidity solution to back the RBI's efforts and the government to keep MSMEs floating. What kind of innovation and digital disruption is happening there? Good to know from you. Pradeep?
Good morning, everybody. Thank you, Ramesh. So we've heard from the esteemed panelists about the digitization initiatives a lot of the companies are undertaking, and how that is the path forward as companies gear up to deal with this pandemic and also strengthen themselves for the new normal, whatever that means when we see it. We've had comments around what is launching collaboration tool to bring employees and customers together, how work from home challenges have been addressed, but obviously Microsoft Office, Teams, many other work from home tools are prevalent today. But what is less obvious is the technology and the tools that companies, large corporations are using to create a more collaborative atmosphere, business environment, trade environment for their own customers and their own supply chains. And that's really come to the forefront over the last 6 months, where, like Giridhar mentioned, a lot of large corporations in India and globally have used their own balance sheet to strengthen themselves. The RBI and the governments have put in a lot of liquidity measures to bring liquidity to large corporations. But the challenge has always remained, how do I now translate that liquidity to my own supply chain and my own customer base, right? And how do I do this in a very collaborative manner? And that's really where C2FO plays a role. C2FO stands for Collaborative Cash Flow Optimization. How do I take the liquidity that I have as a corporate and really push that into the tier 1, tier 2 of my supply chains, and how do I support my own customers as well, so that we as an ecosystem are strengthened and we don't have to rely on the government or the regulators to handhold us through this pandemic, and also strengthen ourselves coming out of the pandemic. So that's really where we play a role. We have over 100 large corporates in India and over 150,000 suppliers that use the platform. Almost 70% of these suppliers are MSME businesses. And that gives us a really nice bird's eye view on how MSMEs are dealing with the challenges. And I'll speak a little bit about some of the initiatives that the government has launched. There's a number of new initiatives that the RBI and the government have championed, which will hopefully position the MSME businesses for a much stronger future. So the first thing is, MSME contributes to about 48% of exports coming out of India. So it's a massive opportunity. The Atmanirbhar package has many initiatives that support the MSME businesses in India. We've heard from our panelists around how about 1.8 lakh crores has been sanctioned by many banks, that is dispersed directly to the MSMEs. This is coming out of the 3 lakh crore credit line that the government has established. But unfortunately, I think the scheme is supposed to expire tomorrow, 31st of October, and hopefully the government will take corrective actions to continue these schemes for the foreseeable future. There are many other things the government has been able to push through. One is changes to the definition of MSME, which was long-standing reform, which has been tabled in the parliament, and that's a positive outcome coming out of COVID. What that also does is it brings a larger base of businesses under the MSME Act and creates a lot of benefit for MSMEs to support their own businesses and support the growth of the economy. The government has championed many other supportive measures like the TREDS, which is a trade receivables exchange to support MSMEs. There are many incentives that are being put in place to support the restructuring mechanisms of MSMEs. There are some interesting updates where any MSME that goes into restructuring will not be called NPA, but they will be considered a standard account as long as they're restructured on time. So the regulators and the RBI are really handholding the MSME businesses to ensure that they are not affected because of these challenges that we are facing as an economy. Having said that, I think it's also important for the government, for their own fiscal prudence, to not paint all businesses with the same color. It's important to distinguish well-run businesses from struggling businesses. There were a lot of stress within the MSME ecosystem even before COVID, and I think it's okay for some businesses to fail, and that's really how we as an economy, as an industry, will evolve and strengthen, and we'll be ready for the next black swan event whenever that happens. So while there are a lot of measures being put in place, but I think it's also important to distinguish that there was stress within the system even before COVID, and it's not necessary that every business survives through this through the pandemic, right? So I'll pause there, and I'm happy to take more questions, Ramesh. I think you're on mute.
Thank you. We had in this conversation, the measures from RBI, and then the importance of the allocation in the 3 lakh crore budget to MSME, and then the implementation and flow of that whole solution down is very critical. I think it just brings home the point that you may have great ideas and great, let's say, economic ideas, but then to flow it to the last mile, is continuing to be a challenge. And I think this is where organizations like yours actually are playing a very good role. Now, I'm going to switch gears. We've got interesting questions also coming up from the audience, so let's reserve some time for that. Let me ask one question to all of you, and I'm going to come around with a quick question. During this whole last 6 to 8 months, all of you must be really looking back, and we actually have got, all of us have got some time to introspect at our homes, given the health, etc., and what introspection also as to what is our role and what we are doing, etc. What's the one big learning you see for your industry? And from that learning, is there an opportunity also you for this industry? I think it's a very, I think many companies like ours also are really rising. For example, remember that in Tata Power, when the entire country was wanting to hear from the PM with the lights off, I don't know, many of you would not know the amount of logistical nightmare and challenge it was to put the lights down in the country for whatever 9 minutes, and see a whole. So we are in the latest blackout in Mumbai. He's teaching a lot about what, as an industry, we must be. What are we supposed to do, and what are we should be bothering about? And I think therefore a lot of learning is coming from that. Similarly, I would ask you, each one of you, maybe I'll start with Giri. What's that one learning which is also bringing an idea of different style of business in the current business model that you have?
No, I think what is sharpening focus, it's a luxury industry. I think what is very important is really look at what the consumer wants and how he's feeling. I think to a great extent, the industry has been supply driven in terms of what we can do for the customer in terms of our own infrastructure. But what we're now seeing is that the customer is behaving very differently, actually. And therefore, I think, how do you reorient your own offering to make sure it is relevant to the customer? And while also making sure that your operating model is kind of driving towards the profitability and return on capital expectations. I think these are the two things I would say. Focus on the customer and make sure that operating models help in return on capital action. I think I'll stop there.
What's your take?
So to me, the one big learning is that things that we would have thought possible were suddenly in a record speed possible. So for instance, just taking virtual closing. Who would have thought 1 year ago that you can do a quarter closing, a year-end closing virtually, and that you can do an audit virtually, that you can do a shareholders meeting virtually. Everything was suddenly possible, and actually quite seamlessly. It's all smooth, all these new things that we have implemented were done in a very short time. It worked out quite well. Also, that people are now working from home, also basically unthinkable a year ago. And now we understand that this is opening up a lot of opportunities even. And one of the big opportunities, I mentioned it already, is now to also boost our digitalization efforts, because now we are kind of forced into digitalization,
right.
Whereas in the past we always talked about digitalization and really drive it. And I think that is the one big opportunity that I have experienced.
Thank you. Of AGMs, I think for years there was a debate that how some shareholder with thousands and hundreds of thousands of shareholders could take a decision with only 50 shareholders present. And there was a proxy system, but nothing like somebody sitting thousands of kilometers away and asking questions to the chairman of the company online, fully legal. I would say it's a great experience. I totally agree with you. Madan, what's your take?
In fact, I think the use of technology, I think that the way in which we are using technology today was something unheard of, and we never really thought it could happen. And look, one danger out here, of course, is that if you look at lots of companies where we feel that technology can do what labor was doing earlier. So I think this is holding in lots of companies, which also means for a labor surplus economy like ours, which talks of demographic dividend, it's going to be a big challenge as to how do you keep people gainfully employed. And just a quick offshoot of this is that we have seen a number of industries which we track, which will go in for a major disruption now. Just imagine maybe 8 months back, if we had this seminar, all of us would be flying to Delhi or Mumbai, wherever you held it. Now just look at it, this entire business of how we conduct these seminars, the aviation industry, the hotel industry, all of them will have to go in for introspection as to whether the old models hold. Entertainment, I think now all of us are watching Netflix, etc. Going to a theater may not be there. So I think there's a lot of disruption which is coming in on account of this advent of technology, which has been good. But for a country like us, I don't know if you're all prepared for it. We could be seeing some kind of pain for these industries.
Right.
Yeah, I think it's an opportunity for as the fellow panelists said, that technology has been a great enabler in getting letting life go as normal. I think for us the big learning and opportunity is that it is also the best time to hire talent. I think this is a time where you want to augment yourself for the future as opposed to firefight. I mean, that is one part of our business or continuity. But the second part is that if you're optimist about the future, you need to, this is the time to resource yourself, this is the time to invest, because you will, as a business, and not just ours, but all businesses will emerge stronger from the crisis. So that's a contrarian view, but that's what we are doing. And I think we put also people before profit and making sure that we retain every job and every individual who's employed with our firm continues to have employment through this period. So that's where we as an organization stepped up to make that happen.
I think we lost you for the last 10 seconds. Okay.
No, I was just saying, I think, contrary. Yeah, thanks.
Okay. So, and also an opportunity could be taken.
So obviously, the first thing is delivery of financial services. So this is something. I mean, services to digital natives, particularly millennials. I think this is a very different ballgame, and flowing in directly from there is this issue of customization, which is, I think, I mean, delivering customized solutions to people. I think this is an enabler. And flowing from there, with the amount of data that is getting generated from the digitalized economy, I think access to credit will become the MSME question that Pradeep was talking about. I think the ability to deliver credit using the data, using analytics to MSMEs will be a huge opportunity going forward.
Right. Great. Lose you, but I would just, in the interest of time, I would the questions, because many questions are coming up, and let me pick up one of the questions. This would go to probably Madan, that when it's a challenging time for economy, how are the stock exchanges really booming, and they're before and after the stock they have been also at similar levels. What does it mean? I mean, there seems to be a level of optimism very different from what you and I are talking in the last 1 hour.
Yeah, actually, the only answer, I think, Ramesh, because it's very difficult to understand why stock markets move the way they do. But we have seen in the long run, there's a very positive correlation with what happens in the economy. So quite clearly, I think today when we're talking of how the stocks are moving, it's more of how it's a forward-looking kind of a statement being made that they do expect things to recover, things to start going back on track. And this is being treated more as a temporary shock rather than a permanent one. I think that's the only way one can really reconcile it. And we've also seen that on a more real-time basis, any announcement made by the government, any negative developments, say, for example, in Europe, that has an immediate impact on stock prices, and then it's back to business as normal. So therefore, I would tend to believe it's more of forward-looking, how we expect earnings to behave in future, which is driving the stock prices.
Or is it capital has begun the Indian stock changes more than they were, geopolitical and other factors? Is there any other thing or explanation to it?
Greed is good. I think that's something that could also be doing it, saying that in this kind of situation, if the valuations are what they are, they're likely to improve, and therefore let's start investing. So everybody's investing out here. But as I told you, it's one market which even I have not really managed to find too much of a reason. But yes, and exposed, I think these are the kind of explanations which we look at. I don't know if Saugata has something on this as an economist.
No, I mean, I think very shortly, this is completely of the M&A deals, which is in the private space. The same thing. Some companies will do phenomenally well, and it is here that these the money, the smart money, and with the flood of global liquidity is moving in.
Right. The next question, this is from Chitramit. What should government do for the lower middle class, where especially a lot of jobs have been lost, and if their purchasing power is increased, it'll benefit the industry also. So what should be, basically, I think what is alluding to is demand creation. So again, probably Madan or any of you, please step in.
If I have to have a quick word out here, I would say that we have probably lost the chance, because I think tax cuts would have really worked well, something which was expected in the 5th tranche of the Atmanirbhar program. But as we've all been discussing, there is this fiscal prudence which the government has decided to follow. I'm saying nothing wrong in that. It's one particular model to be followed. So that's one of the reasons why we haven't seen the government play any affirmative role out here. As I said, most of the government's role has been more of providing relief rather than actually giving a push to either consumption or investment.
Thanks. So there's a good question for you and Giri. How corporate CFOs should prepare business transformation required in terms of digitalization and environmental environmental, sustainability, and climate goals in the forefront, how do we shift our gear as well as attitude or our time spent? EAIP. Word from Daniel.
No, thank you. A very good question. I was just recently also on a panel for digital CFOs. So I think we play a pivotal role here. And then it's also about implementing the right mindset into an organization. As I said, in the past, we always talked a lot about what is digitalization, but then we started also to have a lot of practical use cases, because I believe most important is to have use cases that you're discussing with your customers, that you're also using internally. So drive first internal digitalization, learn out of it, talk to your customers, and see what they are doing on their side when it comes to expectations from digitalization. Also, business models, I think, are very important. So the key to success, in my opinion, is that the whole organization is now lifted towards the opportunities that come out of the digitalization. There should not be much reluctance or resistance. There should be a lot of openness and willingness to tap into this new business fields. And I think that is important. And we as the CFO community, we have to support them. We as the CFO community also have to poke them to look into those. And I was having a lot of discussions also with our accounting teams, tax teams, supply chain, and IT is also playing an important role here to support them. Everywhere you can think about how to make processes more productive by using digitalization, by using big data for plausibility checks, even for internal audits. But there's a variety of fields. Probably you could look into everything that you have in the organization or in your finance community that can be done more efficient, faster, more reliable by using digital technologies. That's the openness, in my opinion, openness, and then also giving credits to the people who are driving this forward.
Giri, go ahead.
Yes, can you hear me? Can you hear me? Yeah, I think, Daniel, you focused on the digitalization aspect, and I will focus on the ESG aspect. I think ESG is becoming even more important at this point in time, actually. I think, so therefore, I don't think organizations can ignore the ESG agenda. I think it is no, it is not just something that is, again, as related to climate change, etc. But I think the whole sustainability equation is even more important at this point in time. And hence, I think we look at our own operating models, when you look at wastages, when we look at what's water conservation, power conservation, environmental protection, because hotels, for instance, can kind of operate in areas where environmental damage can actually take place. And I think the whole ESG area becomes extremely important, actually. And it has major implications on the business, actually. So I think CFOs will need to carefully understand what is the transition requirements from where they are operating to the best in class in terms of ESG, and define a path which allows the companies to invest and change their operating models to be more ESG compliant. So I think ESG is a very big area.
Fully agree.
Just to what you said, I'm finding personally that I think there's a huge pressure on investors and stakeholders of investors say that they are very keen to know how they are investing and where they are investing and how environmentally compatible the investments are, and the number of questions in the investor meets that are coming from a ESG perspective. I come from power sector industry, which is really guzzler of it also throws up a lot of carbon. So the concerns is something which I've never seen before in my career. I think it's a very clear indication that invest number to the return profile, and there's an invisible number in terms of ESG compatibility and I would say coverage. And I think that's the gear. So as CFO, we must probably, a great question it was, that we must focus a lot more time on asking ourselves that are we also ESG friendly apart from EPS friendly? So I think there's a lesson that's being taught by the investor world already. So thanks for that question. The other question is coming from Chitra Mittal, that what role is agriculture playing in the whole economic recovery? scenario. And you know, this sector, thanks to also good was holding the economy in this year. So what is the role going forward? And I think I would put that to Shugata and Madan in terms of the impact agriculture.
No, so agriculture is very, very important, not just for the short-term support, while the other sectors of the economy are down. But on a longer-term perspective, I mean, you know, the set of agricultural reforms announced by the government are very, very important. I mean, this can create a whole ecosystem around the agricultural space. So food processing, transportation, logistics, cold storages, etc. I mean, the entire set of activities that can help to smoothen agricultural prices, deliver better returns to farmers is, I think, a big ongoing process. So in the context of agriculture, I need to point one thing in terms of the implementation of moving India to a $5 trillion economy is this incredible critical importance of coordination between the center and the states. Because remember, not just agriculture, most of the other reforms are now in the domain of states. The center can only play an enabling role. And it is in this context, the federal structure that India is, I think, needs to be leveraged, a cooperative coordination mechanism between the center and the states.
Yeah, just to give a different perspective. See, if I look at the short term, I think agriculture has been one area which was not really impacted by the pandemic, rural India. I mean, at least based on the information. So therefore, if you look at most of the FMCG, consumer durable goods, as well as automobile companies, if you look at all their investor presentations, they have been banking a lot upon the rural demand, especially coming from agriculture, actually spurring demand. Now, what we have seen is that the Kharif crop has been good, but there have been certain damages to crops. So I'm not quite sure as to whether the rural demand will fructify the way in which we thought it would fully. But definitely the prices, if you go look at the APMC prices, they're much higher than the MSP, which is a positive factor in terms of a farmer's income going up. Will they be spending on consumer goods or will they be spending on gold? One is not quite sure. Now, with Dhanteras coming up, there could be a greater demand for gold given the kind of boom we have seen in the price of gold. That is for the short term. In terms of long term, again, I would be a little more pessimistic than Sagato because I feel that most of these reforms which are spoken of, they're great reforms. But we had this removal of these APMC model acts earlier, allowing farmers to sell directly to retailers. It's never really happened because we haven't created an infrastructure for it. So while ideally things like contract farming, which is a good deal, but it hasn't really worked in a big way in terms of selling outside the mandi, it's permitted in some states. I think Bihar was a state which permitted it, but there's been absolutely no progress made there. So I think the will part is more important in implementation of these rules rather than in having these kind of great reforms which are not being implemented. So I think, again, what Sagata said in terms of the states need to do a lot more work there compared to the center because it is the state.
Ramesh, I think I just have a comment there on
very
agriculture.
Interesting point. Sorry, Pradeep, go ahead, please.
Yeah, I was just saying, I think export is a massive opportunity for the commodity and the agriculture space. And I think there's a series of reforms that are pending, including export credit insurance that the regulators can open up and create a more level playing field for our exports. And I think agriculture and some of our rural economies can benefit out of that.
Pradeep goes back to Shravadam. I think there's fundamental reforms this government is trying to do. A different issue how it's get implemented. On the state center issue, I totally agree the way even in power sector, for example, the state and it's a concurrent subject and it's life very difficult for policy implementation. And I don't know where does the legal solution lie to make it more streamlined, or it may be more an accommodation or the way to bring about the interests in a way that, you know, policy making and implementation becomes easier. But I think to identify what's the right model for the state center subject to be handled in a homogeneous manner. Otherwise, we are seeing too much of state versus center issues stopping good, real good intentioned reforms as well. Great. One last point I'm going to ask all of you. There was one really compelling, I would say, policy from the government. One important step. What, in your view, would that be? Right? it could be to your industry, or it could be not pertaining to industry, your industry. It's okay. What is top of the mind comes to you as one important step that happened, and it could make a lot of difference, apart from all the measures that we talked about, all that already happened, and some things are in the works. So I don't know who wants to go first, but that will be a good way to conclude this session.
So if I may go
Shogata, why
first,
don't you start?
Mr. Subramaniam.
Yeah, please.
Very briefly, thank you, sir. Very briefly, ECLGS, I think as a nodal thing, the 1.5 lakh crores out of the government limit that remains. I think that should now be utilized. I think the government should move ahead into the stressed sectors of the economy. Remember, the thing that is now needed is confidence. So one way to increase cash flows in the system to increase confidence is to use the ECLGS lead.
My comment would be around using RBI available liquidity for the government to actually clear its dues to the stressed MSME sector. I think there's over nobody knows the accurate number, but it's well over 50,000 crore, and in some estimates it's maybe even a few lakh crores that's stuck just within the government machinery. And these are outstandings to the small medium businesses in India, and that can create a lot of confidence and bring liquidity to the masses.
So my one, my one ask would be in the context of the opportunity for shift of supply chains from China into India is enforcement of contracts. I think we are ranked pretty poorly, 163 out of 190. If need to focus on enforcement, addressing backlogs in the judicial system, and improving our arbitration mechanism. So that would be one thing that I would ask.
Okay. Okay.
I think Giri here. I think I would simply say that.
Yeah, Giri.
Yeah.
I would have a very practical suggestion. So I'm not going to say there should be another fiscal stimulus, government spending X amount of money, because that's not going to happen. The practical solution is that, yeah. Sorry.
Just 1 minute. About to finish. We just
okay.
Can Giri finish? Giri?
No, I think no, I didn't. I mean, okay, fine, I didn't start. But I think the point is that it's a great opportunity for leadership, which India can now play in the new environment, actually. And I think it's important that we put aside partisan views in terms of what is the right way of going ahead, whether it is stimulus, whether it is things like broad-basing tax into agricultural incomes being taxed. I think this is the time to do all of those bold steps, actually, and improving center-state relationships. I think all of those are the important points. I think we need a very non-partisan approach in terms of driving the next phase of growth, actually, is what I would say.
Right. Go ahead now.
May I?
Yes, of course, ma'am.
Yeah.
Yeah. Okay. No, I was saying that I'll give a practical suggestion. So I'm not going to talk about saying that the government should spend 1 lakh crores, 2 lakh crores on infrastructure. But a practical thing is that we're going to probably have a second wave of infections. Please don't go for an economic lockdown. It's not a sensible thing.
Okay.
And Ramesh, Daniel here, then I can. So I like all the ideas that I have already heard from. Yeah. I like all the ideas that I have already heard from the other panel on giving more liquidity to investors, supporting the need. I would also like to add infrastructure spending is important. I think we have seen this also in other countries. I would like to see the government also taking here all the steps to invest more into infrastructure. And one specific topic I would like to add is bringing back or extending the MEIS benefits, so the incentive schemes. That would be something very, very important to us as well.
Okay. I think, thank you, Daniel. And that's all we have time for. It's been an interesting 90 minutes of discussion. Thank you for your patience in answering. And thank you for the audience too, also for participating and sending out questions. It's been, hopefully we take back some things with optimism, some things with a pinch of salt, and some things for our own actions to do at home. So when I say at home, it could not be office as well. So with that, really thank you once again, and have a nice day, gentlemen. See you in the next session. Thank you.
Thank you so much.
Thank you, Daniel. Thank you, Mr.
Thank
Giridhar.
you.
Thank you, Mr. Sabnavis. Thank you, Pratik, Mr. Bhattacharya, Siddharth, and to Mr. Subramanian, Chairman, for sharing your insightful thoughts as well as experience sharing. I think this will be quite enriching and learning experience for me also, as well as for the participants. So thank you for your time. Greatly appreciate. And thanks to the Chairman for moderating this session. Thank you.
Thank you. Bye-bye.
Thanks.
And participants, the next session is about to join at 12:15. So please join the next session, which is on risks, how CFOs are grappling with the new unknown. So please join the next session for all this convenience. Thank you all.